Hey there, and welcome to our new video. Today, we'll dive deep into the world of growth stocks, how to identify them, the mindset you can adopt, and examples to support our discussion. We'll explore one particular approach to selecting growth stocks. Although there are many methods and choices we could consider, we'll focus on this one today. This approach suggests that before investing in growth stocks, there are 5 key questions to ask. Only when these questions are thoroughly answered should you consider investing your money into specific growth stocks. The questions are fairly straightforward, and I'll provide examples to clarify each one. The first question is the company's revenue doubling exponentially every year, every 2 years, or in some cases, every 3 years? We'll discuss why this is important shortly. To give you an example, a company with a modest revenue of, say, 50 million would be expected to grow to 100 million more quickly. The bar is set higher, and revenue doubling is anticipated sooner. For companies in a different phase, with revenues in the billions, a different pace applies, doubling in 2 or even 3 years. Take Amazon, for instance. It's still seen as a growth stock because it continues to expand its revenue rapidly, from over 100 billion in 2015 to over 200 billion in just 3 years. This is impressive, as revenue and profit often decline at such scales. For a company at this stage, doubling every 3 to 4 years is perfectly acceptable. Question 2 is about the earnings per share growth. Is the earnings per share increasing? In essence, is the company profitable? Yes or no? And if not, why not? If a company is not profitable, they must have a very good reason. It's crucial to be able to convincingly explain why a company hasn't yet turned a profit, and if you can't, it might be best not to invest. We'll delve deeper into the rationale behind this shortly. Question 3. Does the company have a clear competitive advantage? An example could be patents. When Tesla started, for instance, they held many patents but made them open for others to use. Their competitive advantage came from being years ahead in technology and having unique data sets on roads and related systems, thanks to their technological infrastructure. Question 4 is about the business of the company. What is the company's business model? How do they make money? Is it scalable or costly? Does it require a sales team? What does that look like? Think of Google, which pioneered the pay-per-click model, a highly scalable advertising model, making it simpler for virtually anyone to advertise. Or consider MongoDB, which needs expensive salespeople and IT implementation specialists to sell and implement their product. Their product, however, is incredibly sticky, as it involves databases holding all a company's documents and data. Changing databases would be risky and time-consuming, so if MongoDB makes it easy for clients, they hold significant power. Plus, moving databases is costly due to implementation expenses and other factors. Now let's move on to the 5th and final question. Question 5. Do I believe this stock has the potential to grow at least 10x in the next 5 years or more? If you don't believe in this potential, why invest at all? Answering these questions positively and thoroughly is my criterion for investing in a growth stock. However, don't take question 5 too literally. You can never be entirely sure if something will grow tenfold, but the stock must at least have the potential for such growth, determined by thoroughly answering the first 4 questions. Now, we will guide you through the research process. It's not like we're always on the lookout for growth stocks, but if we get certain tips or see something interesting in various forums and articles, we like to investigate further. If you already possess extensive knowledge about a specific sector, you can leverage that expertise to effectively answer questions 3 and 4. One of the best ways to do so is by exploring the company's official website and reading various articles, press releases, and reports. This thorough research will help you ascertain whether the company has a clear competitive advantage, understand its business model, and evaluate the quality of its products. However, you would only want to invest in the company if you see exponential revenue growth and a rising EPS. If this is not the case, you will naturally want to investigate further to understand why that might be the case and what steps could be taken. For questions 3 and 4, you can delve deep into the company, visit its website, and read various articles. Your own knowledge plays a significant role here too. Doing thorough research within the company itself will help you discover the answers and provide well-informed responses. To answer questions 1 and 2, it is easy to use a site like MacroTrends. Here, you can find virtually everything needed to perform technical or financial analysis. In the Finances tab, you can do a fundamental analysis, where you will find all the financial figures needed for this. You can also check the investor relations page of the company itself to ensure that the figures are correct before making a financial decision. If you don't know how to read a balance sheet, we would actually recommend learning that. It's quite easy, and you can make it very easy for yourself to find golden nuggets, so to speak. We will now give another example that looks a bit easier, but if you want, we can also make a video once about how to properly read a balance sheet. If you want that, please let us know in the comments, and maybe we will make a video about it, or another topic you would like to know more about. Now we will look at Tesla's revenue growth. Tesla was always, and often still is, mentioned in the news as a company that makes a lot of losses and does not achieve production targets. You name it. But you'll see that in reality, when it comes to hard facts, it has grown exponentially, especially for the numbers they were doing in 2015. $4 billion in revenue, and in 2016, $7 billion. That is not a doubling. But if you look every 2 years, you see it went from $4 billion to almost $12 billion. That's a tripling. You see here in 2016, $7 billion, while in 2018, $21 billion. That is also a tripling. So this is really a fast-growing stock that sees high revenue growth. Tesla, however, has only been profitable since the past year, and there were always many people who said, yes, but Tesla doesn't make a profit, Tesla makes losses. When it comes to growth stocks, they do not necessarily have to make a profit. If they do, it is a nice bonus, and those are really the real golden nuggets, so to speak. We will shortly give an example of a company that does this. However, these types of companies are often also very expensive to buy. But it makes sense, of course, because they make a profit and the company is doing very well. So it's logical that this happens. In the tech world, and particularly in the realm of growth stocks, there are two distinct types of companies that are often discussed. These are bootstrapped companies and leveraged companies. Bootstrapped companies are those that can tie their own shoelaces, so to speak, meaning they finance their growth internally without external funding. On the other hand, leveraged companies, such as Tesla used to be, rely on borrowing capital to fuel their growth. Leveraged companies inherently carry more risk. This means they need to devise a solid business plan to reassure investors. For instance, in the case of Tesla, key metrics often scrutinized include margins, revenue growth, production targets, and the viability of new products being introduced to the market. Elon Musk is known for his ambitious promises, which sometimes experience delays, but Tesla has always shown immense potential for the future. Even if Tesla were not to succeed as a car manufacturer, several other avenues present potential opportunities. Consider, for example, autopilot technology, which could become the operating software for all cars in the future. Imagine a scenario where Volkswagen vehicles operate using Tesla's autopilot. Another exciting prospect is the concept of robot taxis, potentially overtaking the market share of platforms like Uber. These are speculative future visions, you might think. While it's true that these prospects are speculative to some extent, since they pertain to future developments, Tesla has solid business models and plans backing these ambitions. You can read all these in detail in their investor relations page if you ever want to take the time and effort to delve into it. Let's look at Apple as another illustrative example. When Apple first started, it was primarily a computer company producing the iMac and various other computers. At that time, analysts were puzzled as to how to value such a company because Apple had future plans to create and market products like the iPhone and iPod, which were uncertain yet. Fast forward to today, and those plans have materialized, transforming Apple into the tech giant it is now, with ventures like Apple Pay and the App Store among many others. Therefore, it's not always immediately necessary for a company to be profitable to be considered a viable growth stock. However, it's important for responsible investors to look at the business plan, the doubling of revenue over time, and sustained growth. Some companies that were once classified as growth stocks may now be slowing down a bit. A prime example of this is Salesforce. In 2016, the company generated a revenue of $6 billion and experienced significant profit growth after previously incurring losses. In 2017, this revenue increased by $1 to $2 billion, and earnings per share doubled. By 2018, Salesforce's revenue nearly hit $10 billion, which still represents doubling of revenue and a 3.5-fold increase in profit. Ideally, this is what you want to see in a stock. Eventually, they start making a profit. We live in a capitalistic world, which means that, at the bottom line, companies must make a profit. You want to see them making enough profit to return capital to shareholders and companies in the form of dividends and other payouts. This is where a growth stock ideally transitions. Salesforce, for instance, may not experience the same tenfold growth in the coming years, so it can no longer be considered just a growth stock, but rather a dividend growth stock. They still pay out a small portion annually, and their payout ratios are low, so the dividend can only continue to grow in the future if they maintain their current trajectory. Another example we want to give you is MongoDB, a company that facilitates operations based on NoSQL databases. If you're not familiar with that, don't worry. In 2016, they had $65 million in revenue, but incurred much higher losses. They operate in a sector where significant initial costs need to be made, including server costs and workforce expenses, to ensure actual growth happens. Many investors are hesitant to invest in such stocks because they are very costly. The price-to-earnings ratio for these companies is often exceptionally high. However, the advantage with such companies is that as they continue to grow their revenue, the PE ratio naturally decreases because earnings are expected to increase over time. Another growth stock that might surprise many people is Amazon. As of now, Amazon has almost $600 billion in revenue in 2024, but in 2020 it was just $280 billion. This increased to $386 billion in 2021, $469 billion in 2022, and $513 billion in 2023. This means that within 3 years, Amazon doubled its revenue from $280 billion. People often wonder what contributes to such growth in companies like Amazon. The answer is straightforward. As a company, you eventually reach a point where growth needs to come from diverse business units. Amazon, for example, is not just an e-commerce company. They also have subscription services like Amazon Prime, cloud services through AWS, which is one of the largest in the world, competing mainly with Microsoft, and other ventures like Audible, which generate significant revenue. The more of these revenue streams they have, the more markets they penetrate, and in fast-growing markets, the more they can earn. Despite having lower earnings relative to revenue, Amazon continues to invest heavily back into the business, paying less in taxes and fostering further growth. Alright, the idea was to keep this video short, but still provide you with valuable information that you can actually use. When considering investing in a company, always make sure to do your own research thoroughly. Don't just take information blindly from others. Verify and validate it on your own. We hope that you learned something from this video and found it enjoyable. If you have any specific questions, please let us know in the comments section. Also, don't forget to like this video and subscribe for more content.